Intermediate Accounting, Chapter 5, Financial Position and Cash Flows. Chapter 5, Financial Position and Cash Flows, 1 of 2. After studying this chapter, you should be able to 1. Understand the statement of financial position and statement of cash flows from a business perspective. 2. Identify the uses and limitations of a statement of financial position. 3. Identify the major classifications of a statement of financial position. 4. Prepare a classified statement of financial position. 5. Identify statement of financial position information that requires supplemental disclosure. Chapter 5, Financial Position and Cash Flows, 2 of 2. After studying this chapter, you should be able to 6. Identify major disclosure techniques for the statement of financial position. 7. Indicate the purpose and identify the content of the statement of cash flows. 8. Prepare a statement of cash flows using the indirect and direct methods. 9. Understand the usefulness of the statement of cash flows. 10. Identify differences in accounting between ASPE and IFRS, and identify the significant changes planned by the IASB for financial statement presentation. Financial Position and Cash Flows. Usefulness from a business perspective. Analyzing a statement of financial position, assessing earnings quality, assessing the creditworthiness of companies. Statement of financial position. Usefulness and limitations of the statement of financial position, classification in the statement of financial position, preparation of the classified statement of financial position, balance sheet, information requiring supplemental disclosure, techniques of disclosure. Statement of cash flows, purpose, content, and format of a statement of cash flows. Preparation of the statement of cash flows. Usefulness of the statement of cash flows. IFRS ASPE comparison. A comparison of IFRS and ASPE looking ahead. Business perspective. A statement of financial position provides information about liquidity and solvency to assess risk of investment, details about the company's financial structure to assess financial flexibility. The SFP can be used to assess creditworthiness, ability to service debt, debt-to-asset ratio. A statement of cash flows can be used to assess earnings quality, earnings manipulation, net income significantly higher than cash flows from operations, issuance of shares to offset negative cash flows. Statement of financial position usefulness. Statement of financial position, SFP, also known as the balance sheet under ASPE. SFP provides information for evaluating the capital structure and for computing rates of return on invested assets. It is also useful for assessing a company's liquidity, time until asset is realized or liability has to be paid, solvency, ability to pay debts and related interest, financial flexibility, ability to respond to unexpected needs and opportunities. Statement of financial position limitations. 1. Many assets and liabilities are stated at historical cost. Information presented is reliable. However, reporting at current fair value would result in more relevant information. 2. Judgment and estimates are used in determining many of the items reported on the SFP. Many soft numbers, or estimates, are included that could be significantly uncertain. SFP does not report items that cannot be recorded objectively, for example, internally generated goodwill. Statement of financial position classification 1 of 3. Similar items are classified or grouped together with subtotals. Items with different characteristics are separated. Individual SFP items should be reported separately and in sufficient detail in order to allow users to assess amounts, timing, and uncertainty of future cash flows, allow users to evaluate liquidity, financial flexibility, profitability and risk, helps to calculate important ratios, for example, current ratio to assess liquidity. Groupings: monetary assets, financial instruments. Statement of financial position classification 2 of 3. Considerations for reporting items separately. 1. Assets that differ in their type or expected function. For example, inventory versus capital assets. 2. Liabilities with different implications for the entity's financial flexibility. For example, long-term debt versus current debt. 3. Assets and liabilities with different general liquidity characteristics. For example, cash versus receivables. 4. Assets, liabilities, and equities with characteristics that allow for easy measurement or valuation. Statement of financial position classification 3 of 3. Assets: current assets, long-term investments, property, plant, and equipment, intangible assets, other assets. Liabilities and equity: current liabilities, long-term debt, shareholders' equity, capital shares, contributed surplus, retained earnings, accumulated other comprehensive income, other surplus. Current assets 1 of 2. Current assets are cash and other assets expected to be realized within 1 year from the balance sheet date or within the normal operating cycle, whichever is longer. Generally, presented in order of liquidity, normally cash, short-term investments, receivables, inventory, and prepaid expenses. Current assets 2 of 2. Operating cycle for manufacturing companies. Manufacture products, sell products to customers, cash, purchase raw materials, manufacture products, and the cycle goes around. Current assets, cash, includes cash and cash equivalents. Defined as cash, demand deposits, short-term liquid investments convertible to a known cash amount and not subject to material value changes. Any known restrictions to availability of cash must be disclosed. Current assets, short-term investments. Investments in debt and equity securities are presented separately from other assets. Valued at cost or amortized cost or fair value. Current assets, receivables. Amounts should be reported separately based on the nature of their origin. 1. Ordinary trade accounts. 2. Amounts owing by related parties. 3. Other substantial unusual items. Separate disclosure required for 1. Amount and nature of non-trade receivables. 2. Receivables pledged as collateral. Accounts receivable valued at net realizable value. Current assets, inventories. Assets that are held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of service. Valued at lower of cost and net realizable value. Cost is determined by cost formula. For example, FIFO, weighted average, specific item, and must be disclosed. Manufacturing enterprise should disclose completion stage of inventories, raw materials, work in progress, finished goods. Current assets, prepaid expenses. Defined as expenditures already made for benefits to be received within 1 year or operating cycle, whichever is longer. Most common examples include insurance, rent, advertising, supplies. Current practice is to report some prepaid amounts as current assets even if the benefit extends beyond 1 year or operating cycle. Non-current investments. Non-current investments normally consist of one of the following: debt securities, equity securities, sinking funds, tangible assets held as investments. Investments are intended to be held for an extended period of time. Valuation options are fair value, amortized cost, equity method. Property, plant, and equipment. Physical, tangible assets used in ongoing business operations of the business to generate income. Generally reported at cost or amortized cost. IFRS allows for valuation at fair value. Most assets are depreciable, except for land. Written down when impaired. Intangible assets and goodwill. Intangible assets are capital assets without physical substance, held to generate revenue. Higher degree of uncertainty regarding future benefits. Include most common patents, copyrights, franchises, trademarks, and trade names. Intangibles are grouped into two categories: those with finite life, amortized over useful life, those with indefinite life, not amortized. Both are tested for impairment. Goodwill may be acquired in a business combination. It's not amortized, but tested for impairment. Other assets. Some of the items included are assets and special funds, non-current receivables, deferred income tax assets, property held for sale, advances to subsidiaries. Sufficient information to be disclosed to inform users of the nature of the asset. Current liabilities. Obligations due within 1 year from the date of the SFP, or within the operating cycle, whichever is longer. Examples of current liabilities include payables resulting from acquisitions of goods and services, collections received in advance of delivery of goods or performance of services, other liabilities to be paid in the short-term financing payable on demand, for example, amounts borrowed under a line of credit, derivative financial instruments. Accounts payable normally listed first. However, current liabilities not reported in any specific order. Working capital. Current assets minus current liabilities equals working capital, a key indicator of the company's short-term liquidity. Not usually disclosed on the SFP, often calculated by bankers and other creditors. Long-term liabilities. Long-term obligations are those not expected to be paid within the normal operating cycle. 3 types. Obligations arising from specific financing situations, for example, bonds. Obligations from ordinary operations of the business, for example, pension obligations. Obligations arising from ordinary business operations that are contingent on future events, for example, product warranty. SFP presentation requires reporting the portion due within the next year as a current liability. Shareholders' equity, capital shares, exchange value of issued shares, disclose authorized, issued, and outstanding amounts. Contributed surplus, usually reported as one amount, includes issued share premiums. Retained earnings or deficit, the amount of undistributed accumulated earnings or losses, presented as one item. Accumulated other comprehensive income, includes unrealized gains and losses on fair value through OCI investments, certain types of donations, etc. Other required disclosures. 1. Contingencies, ASPE, and provisions, IFRS. Material events that have an uncertain outcome resolved in the future. Contingent gains not recorded under IFRS or ASPE, just note disclosure. 2. Accounting policies. Significant accounting principles and methods chosen by management. Information about the use of estimates in preparing the statements. 3. Contractual situations. Contractual obligations, that is, terms and conditions. Commitments that require specific actions, for example, maintain working capital at a certain level if material. 4. Subsequent events. Further evidence of conditions that existed. conditions that occurred after the statement date. Additional detail. Techniques of disclosure. 1. Parenthetical explanations following the items in the SFP brings the information into the body of the statement. 2. Notes to the SFP reduces amount of detail on statements. 3. Cross-references and contra and adjacent items such as accumulated depreciation and bond premiums. 4. Supporting schedules to provide detail for single-line items. 5. Terminology. Statement of cash flows, 1 of 2. To assess the firm's ability to generate cash and cash equivalents, and to allow comparison of the operating performance and cash flows of different entities. Statement of cash flows shows where the cash came from, what the cash was used for, the change in the cash balance. Statement of cash flows, 2 of 2. Cash activities are divided into 3 main categories. Operating activities, main revenue-producing activities. Investing activities, changes in long-term assets and investments. Financing activities, changes in equity and borrowings. Cash inflows and outflows. Operating activities, inflows of cash. Net income and adjustments to reconcile net income to cash flow from operations. Investing activities, sale of property, plant, and equipment, sale of debt or equity securities of other entities, collection of loans to other entities. Financing activities, issuance of equity securities and issuance of debt, bonds, and notes. Outflows of cash, operating activities, net loss and adjustments to reconcile net loss or income to cash flow from operations. Investing activities, purchase of property, plant, and equipment, purchase of debt and equity securities of other entities, loans to other entities. Financing activities, redemption of debt, reacquisition of capital stock. Preparation of the statement of cash flows, 1 of 11. Preparation methods. Direct method. Restates operations on a cash basis, includes specific cash inflows, outflows, for example, cash received from customers, cash paid to suppliers and employees, interest paid or received, taxes paid, etc. Indirect method. Reconciles accrual net income to cash-based net income. For example, adds back non-cash charges deducted from net income, such as depreciation. Only the operating activity section differs between the 2 methods. Preparation of the statement of cash flows using the indirect method. So this example, you have January 1st, 2020, issued 30,000 shares for 30,000 cash, rented additional office space, purchased furniture and telecommunications equipment and did some marketing. December 31st, 2020, purchased land with fair value of $150,000 for $100,000 in bonds. December 31st, 2020, issued $100,000 in bonds, paid dividends $15,000. Preparation of the statement of cash flows, 3 of 11. For operating activities, adjust net income of $75,000 on an accrual basis to a cash basis. For those items on the income statement that do not affect cash, add depreciation expense $30,000. For those items that are affected by changes in current assets and liability accounts, subtract increase in accounts receivable $41,000, add decrease in inventory $20,000, add increase in accounts payable $12,000. Net cash provided by operating activities equals $96,000. Preparation of the statement of cash flows, 4 of 11. Cash flows from operating activities, net income $75,000. Adjustments to reconcile net income to net cash provided by operating activities, depreciation expense $30,000. Increase in accounts receivable $41,000. Decrease in inventory $20,000, increase in accounts payable $12,000, Subtotal that, $21,000. Net cash provided by operating activities, $96,000. Preparation of the statement cash flows, 5 of 11. Analyze the balances for land and property, plant, and equipment for investing activity. Land increased by $150,000, offset by an issuance of $100,000 in bonds. Minus purchase of land, $50,000. Property, plant, and equipment, net of accumulated depreciation, increased by $100,000. $100,000 plus $30,000. Minus purchase of property, plant, and equipment, $130,000. Net cash used by investing activities, $180,000. Preparation of the statement of cash flows, 6 of 11. Cash flows from investing activities. Purchase of land, $50,000. Purchase of property, plant, and equipment, $130,000. Net cash used by investing activities, $180,000. Preparation of the statement of cash flows, 7 of 11. Analyze long-term liabilities and equity for financing activities. $30,000 from the increase of common shares, plus issuance of common shares, $30,000. Paid dividends of $15,000, minus paid dividends, $15,000. Issued bonds, $200,000 minus $100,000 non-cash increase, plus issued bonds, $100,000. Net cash provided by financing activities, $115,000. Preparation of the statement of cash flows, 8 of 11. Cash flows from financing activities. Issuance of common shares, $30,000. Issuance of bonds payable, $100,000. Payment of cash dividends, $15,000. Net cash provided by financing activities, $115,000. Preparation of the statement of cash flows, 9 of 11. Condensed statement of cash flows. Cash flows from operating activities, $96,000. Cash flows from investing activities, $180,000. Cash flows from financing activities, $115,000. Net increase in cash, $31,000. Cash at the beginning of the period, $30,000. Cash at the end of the period, $61,000. Preparation of the statement of cash flows, 10 of 11, using the direct method with the same information. Preparation of the statement of cash flows, 11 of 11. Cash flows from operating activities using the direct method. Cash flows from operating activities. Cash received from customers, $539,000. Cash paid to suppliers and employees, $418,000. Taxes paid, $25,000 for a subtotal of $443,000. Net cash provided by operating activities, $96,000. Usefulness of the statement of cash flows. Provides creditors with useful information about a company, such as company's ability to generate net cash from operating activities. Net cash flow trends or patterns from operating activities. Major reasons for positive or negative net cash from operating activities. Whether the cash flows are renewable or sustainable. Financial liquidity. Current cash debt coverage ratio. Indicates a company's ability to repay its current liabilities from its operations. Net cash provided by operating activities divided by average current liabilities equals current cash debt coverage ratio. Financial flexibility. Cash debt coverage ratio indicates a company's ability to repay its liabilities from net cash provided by operating activities without having to liquidate the assets it uses in its operations. Net cash provided by operating activities divided by average total liabilities equals cash debt coverage ratio. Perspectives. Cash flow patterns. There may be useful patterns identified of cash inflows and outflows from operating, investing, and financing activities. Predictive value. Free cash flow. Calculated as net cash from operations less capital expenditures and dividends. Indicates discretionary cash flow, cash left to invest or expand, to make additional investments, to retire its debt, or to add to its liquidity. Free cash flow analysis answers questions. Can the company pay dividends without external financing? If operations decline, will the company be able to maintain its required capital investment? A comparison of IFRS and ASPE, one of two. Statement of financial position. Items in the statement of financial position / balance sheet. IFRS, traditional elements plus investment property, biological assets, and provisions. ASPE, traditional elements plus government assistance receivable, specific investments accounted for using the cost or equity method. Current versus non-current liabilities. IFRS, show as current if no right to defer payment of a financial liability beyond 1 year as at the SFP date. ASPE, show as non-current if debt has been refinanced by the date of issue of the balance sheet. A comparison of IFRS and ASPE, 2 of 2. Statement of cash flows. IFRS, investments. Certain preferred shares close to maturity may be classified as cash or cash equivalents. ASPE, equity investments are excluded from cash and cash equivalents. Interest and dividends, IFRS, may be classified as operating, investing, or financing activities. ASPE, included in net income under operating activity, part of retained earnings, financing activity. Disclosure of cash flow per share information. IFRS allowed, ASPE is prohibited. Date financial statements authorized for issue. IFRS must be disclosed, ASPE no requirement for disclosure. The end.